We're going to get the spoken word now on how the September jobs report might impact the stock market and this rally, if at all, with our chief equity strategist, John Blank, who joins me now. So, John, the September jobs report, after a delay because of the log jam in Washington, finally was issued. Initially, the market kicked up a little bit on the news that just 148,000 jobs were added, a significantly less amount than the street was looking for, but the unemployment rate fell to 7.2%. So a little bit of a market kick-up in the stock market on that news. Perceived as market-friendly, why exactly?
Well, yesterday, Terry, we had a housing report that came in pretty weak, and part of that weakness was the affordability of housing, which is driving up GDP growth, which is driving up job growth in this type of recovery, is weakening. And the affordability is a five-year low, So we're 5 years ago, things were really in a spot where it's starting to get expensive to buy a house, and that's creeping into the job numbers. And so what you look for within the affordability is what are the issues. One is mortgage rates. They have been rising because the taper was supposed to happen. Now they're falling. And today the 10-year fell on this news because now it says, hey, if affordability is a problem, if the jobs are not being created by the construction and housing boom, then we expect the Fed to taper longer. And the 10-year Treasury responded to that immediately, and we saw the stocks go up from that effect. But that's not the only effect. You have stagnant incomes, which is the 7.2% unemployment rate. You can't get incomes to broadly rise in an economy in any forceful way until you get to about a 6% unemployment rate. So we're doing 0.5% of an unemployment a year at this rate. We're 2 years away from that. So we have a stagnant income situation. And then the final thing you have is the housing prices are rising too fast, right? Which is yet another effect that we're trying to get ourselves away from. But the bottom line is the market looked at all these effects, stagnant incomes, rising margin rates, and the house pricing. All of that says, let's let the Fed taper longer because 2 out of 3 of those things will be less hurtful if the Fed stays in the game, and that's what is beneficial for stocks.
All right, so it's perceived that this does not support taper. That
this does not support taper.
Does not support taper sooner rather than later.
This does not support taper sooner. It supports taper later.
All right, but let me ask you this. The September jobs data was really not affected by the government shutdown. It was assembled prior to the government shutdown. So might that fact impact Fed thinking as far as taper is concerned?
Doubtful, because they had a Fed shutdown or a government shutdown in September. So the October meeting was where they would have some issues with using this preliminary data is almost certainly not going to happen because they're so worried about the cost of that shutdown, which will hit in the fourth quarter. So there's absolutely no way that these preliminary numbers are driving Fed thinking. Because when they will drive Fed thinking would be in December or January, and by that time they will be revised numbers, like we saw with the August numbers today that were 995. They can move up, they can move down, and that's when they have more confidence in the numbers and when they would react to them.
Okay, just as a viewer note, the yesterday that John referred to was October the 21st. We're sitting here talking about this on October the 22nd. Finally, John, volatility in the market. You expect more volatility in the market because of this September jobs report?
No, I expect less volatility because it puts the Fed in the game longer.
Okay, John, thank you for that. There you have it, the spoken word from our chief equity strategist, John Blank. With John, I'm Terry Ruffalo.